Since our last live stream, there have been two sort of big events, I think, that we can possibly talk about and figure out how to trade around. One, of course, is the attack that Israel is launching against Iran to try to disable their ballistic missile and nuclear capabilities, which apparently were very close. They were developing uranium. And the other is the Air India crash. We're going to talk about both of those. Hello everybody and welcome. I'm Mike Co. Welcome to Open Mic. So I think I'd like to start with the Air India crash. This is obviously a tragic event, and it involves the loss of nearly 300 lives. There were 242 souls on board the plane, apparently one survivor, so 241 were killed, and then a number of people on the ground. The aircraft involved was departing Ahmedabad in India last Thursday. It was headed to Gatwick Airport in London, and the aircraft involved was a Boeing 787 Dreamliner powered by GE's GE NX engines. This is the first fatal hull loss for a Boeing 787, which had a nearly impeccable safety record before this. The only other hull loss incident involved a battery fire, but that plane did not involve any fatalities. That occurred while the plane was parked. So the reason I'm bringing this up is because the Boeing stock, first of all, it fell about 6%, I think, on Friday after this news. And I want to point out that I'm not a pilot, so I'm not an expert in these matters, although I am very interested in them. There are some very good YouTube channels I would like to point out, though, that can provide some more details on the things I'm going to talk about here a little bit. One of them is a channel that is run by a fellow Northern Californian. His name is Juan Brown. He's a 777 pilot, and his channel is called the Blanco Lirio channel. There's another channel, Captain Steve, which is also a commercial airline pilot's YouTube channel where he goes into these things. He's done more updates about this. And then finally, Max Afterburner, and there are numerous others. Max Afterburner is a former F-15E fighter pilot. I believe he also flew the Airbus 220, maybe the Boeing 737 for many years as a commercial airline pilot. So what is it that makes it worth discussing for us on this channel? And that is that the cause of, or causes, oftentimes there can be more than one thing that leads to a fatal accident, but the cause of the accident may have implications for the companies involved. So the 787 has different engine options. GE, as I already pointed out, manufactured the engines that were in the accident aircraft. Rolls-Royce Trent engines are one of the alternatives. And when the accident first took place, there were two videos that were available. I would encourage you to go and take a look at those. One was CCTV footage that appeared to be from the airport itself or just off of it. You can see the airplane taxiing down the runway for takeoff. You can actually see it lift off. You'll notice that the gear never retracts. A lot of people pointed to that and identified it as potential pilot error at the time. They were basing it, of course, on very limited information. The idea is that when a plane takes off and the pilot monitoring says positive rate, indicating that the plane is climbing, then the pilot in command would say gear up, and they would retract landing gear. That didn't happen as soon as the plane started to take off. So a lot of people were suggesting that that meant that there was some kind of a human error involved, and that maybe there was a mistake made in the cockpit where rather than retracting the gear, they had retracted the slats and flaps. That's pretty unlikely by most reckoning of professional pilots, because the handles are not in immediate proximity to one another. They are distinct to avoid exactly that kind of an issue. But then there was a subsequent bit of video footage which might be more revealing. And that was taken by a student who lived in the neighborhood, who apparently was standing either on his rooftop or something close to it, and videoed the plane as it flew by at low altitude. And as it went by, one of the things that got picked up in that video was a very distinct sound of a propeller spinning at high speed. And the reason that's important is because that sound could emanate from something called the RAT, or the ram air turbine. The ram air turbine is something that gets deployed if there is a total loss of electrical and hydraulic pressure in emergency situations. It's basically a propeller-driven generator that drops out. It would be, if you're looking at the footage, it's very hard. These are very grainy images. But if you were looking at it, the right rear landing gear at the trailing, sort of at the end of the, behind it to the right, you might make out a slight shadow there. And that would be where the ram air turbine, which would probably in footage like that be very hard to make out. Now, if that was deployed, that hints instead that the insufficient lift was more likely caused by engine failure. And because each of those GE engines generates probably north of 65,000 pounds of thrust and is sufficient, the plane actually can take off and climb on a single engine. That is consistent with what CNBC, it should be said. So I read this in CNBC. I have not listened to the audio tapes. But apparently they did send out a single mayday call and indicated a loss of thrust. So the combination of the loss of thrust on the mayday call, if that's what happened, and the possible deployment of the ram air turbine suggests that there was an engine failure. Now, we've seen a couple accidents, including the Jeju air crash involving a 737 in Korea that involved engine failure. In that case, it was due to a bird strike, migrating ducks. They have a lot of birds there. But apparently no remains were found on the runway. No birds were spotted in any of the two videos that I've seen anyway, and none, there's been no indication that that was the case. So why is this important? Well, there are, of the causes, there could be human error. That human error could come from the cockpit. That human error could come from mechanics. There could be mechanical failure that may not necessarily have a human cause, we should say. There could have been bad fuel was something that was proposed. I've also heard it proposed that the plane was it was 40 degrees centigrade, about 104 degrees Fahrenheit that day, and some footage from inside the cabin and an earlier passenger on a flight that had just arrived there indicated that the interior of the cabin was extremely hot. So others are suggesting that high heat could have caused some problems with the fuel system. Suggesting some have said that maybe that some vapor had built up in the fuel lines. In any case, a dual engine failure of this type is exceptionally unusual. And the timing of it must have been at one of the most critical phases, because as the plane is going down the runway, at V1, that's essentially the determination of whether or not they're actually going to proceed with the takeoff, regardless. And so clearly they had made it past V1 and decided to rotate, and we don't know whether the issues that they confronted started to take place as they did so or immediately thereafter, but the plane was only in the air for about 25 seconds. So, the reason I bring all of this up is because if we take a look, so Boeing, unsurprisingly, Boeing has been dealing with the issue related to the 737 MAX aircraft, which started with the Lion Air crash. There was two crashes, one in Ethiopia and one in Indonesia. For those who do not remember, I'm not going to get into it in great depth, but I'm going to summarize it here. The gist of it is that the single aisle aircraft. So the Boeing Dreamliner is a wide body aircraft. It's a dual aisle aircraft. So it's not competing with the A320 from Airbus and the 737. So these are smaller aircraft. But the 737 MAX issue, which caused huge problems for Boeing and massive losses and a real loss of face and faith for the company, involved their decision to make some modifications to the 737, which was designed in the 1960s to compete with a new, more fuel-efficient design of Airbus's A320 Neo, which had some new engines fitted. Why was this important? Well, the new engines that were being fitted were of a larger diameter. And the reason that was important in the context of the 737, something I've talked about on this channel before, is that the 737, if you look at a picture of it, there's a couple things that are very characteristic of the airplane. One of them is that it has a very large rudder, which was actually involved in another tragic accident. And the other is that the plane, when it's on its gear, sits relatively close to the ground, which made fitting larger engines basically impossible unless they put the engine pylons and mounted the engine slightly further forward and slightly elevated. That changed the flight characteristics of the aircraft somewhat. The way Boeing engineers dealt with that was they embedded some autocorrective software into something called the MCAS system. And the reason they did this is because, as I've also previously alluded, one of the reasons that we keep seeing sort of upgrades and updates to existing aircraft rather than clean sheet designs, which the 787 was and the 777 was, is because the costs of training up pilots on new aircraft types is considerable. And so to remain competitive in this space, both Boeing and Airbus, when and wherever possible, try to make minor modifications to popular aircraft types so that they can minimize the cost. It's an attractive selling point to the airlines who are trying to do two things. They want airlines that suit their specific needs. They want airlines that are fuel efficient. And they also want to minimize the expense and time involved with training up flight crews. So in this particular case, this is a kind of a new situation because we're dealing with a plane quite unlike the 737 MAX situations. This plane was, we'll call it middle age at least, so that I believe the 787 was first released in 2011. We can probably get confirmation on that. This plane was one of the earlier ones, so it was more than a decade old as I understand it. I also understand that a passenger on the plane made a video and complained about a lot of things not working properly. So the question we then have to ask ourselves is there any potential implications for the manufacturers? Well, we don't really know at the moment. Had it been exclusively pilot error, then of course Boeing and GE wouldn't have been at fault at all. But it appears that the preponderance of the evidence at this point, at least, with respect to the RAT, which again is the ram air turbine. It's an emergency generator that deploys on a spring that spins up at a very high RPM to generate power when hydraulic and electrical power is lost from the two main sources, which is going to be the engines. That hints that there was a mechanical problem. Now, a mechanical problem doesn't mean that either Boeing or General Electric are responsible in any way. We don't know. But we do know that that the likelihood is slightly higher, of course, right? So this being more than a decade-old airplane, there's a lot of things. It could be a maintenance issue. It could have been a fuel issue. But my point would be that Boeing, at this point, has only responded very modestly to this news. And I think it would not be unwise for people who have investments in Boeing, because this was a popular stock this year. In fact, several of my colleagues, I believe, on CNBC had picked Boeing as one of their acronym names. I did not, but I had a slightly different reason, and I'd like to talk about that right now, which is that a lot of the bad news for Boeing was indeed seemingly behind it with respect to the 737 MAX issues. And this was a really profound impact on the company. If you take a look at these financials, you'll notice that the company which had really been humming right along up until 2018 or so. The first of the 737 crashes, which wasn't being blamed on the airline, on Boeing, on the airline manufacturer at the time, until the second crash took place and they started to ground the 737 MAX fleet to try to get into it, that the company had been generating, and I think it was, let's see, last year, so we had $9.4 billion in adjusted net income for the full year 2018. So this was after the first 737 MAX crash, but prior to the crash in Ethiopia. You can see right here, if you take a look at the adjusted net income, what the implications were since. The company has taken on a massive amount of debt since then as it has dealt with the fallout of this. Now, there have been other problems as well. There was the plug door that was not properly affixed to the fuselage of a new plane that popped out in flight. Happily, I don't think there were any fatalities in that. But all of these things, the whistleblower on the 787 project, which actually post-dated the manufacture of the airplane in question, but all of these things were casting some concerns and doubts about Boeing. And look, obviously, I'm rooting for the company. We only have a duopoly now. Unfortunately, I rather wish that we hadn't had quite as many mergers and acquisitions in the domestic aerospace industry, such that we would have more, sort of a more competitive landscape. But this is where we find ourselves, that basically, especially in the manufacture of the larger aircraft, so this is not an area where Bombardier and Embraer compete, that is basically Airbus and Boeing. But you'll observe that if you go back to 2018, the enterprise value of the company was about $188 billion. Right now, the enterprise value of the business is about $188 billion. We are essentially right where we were at the tail end of 2018. And at the tail end of 2018, that was before there was any kind of, any of the sort of the bad news that I've just outlined took place. So meanwhile, we could expect, and we did expect, things to start to normalize for the business. But the question you might ask yourself is, net of everything that has happened and the fact that there's still some cloud here as a result of this, is the company worth as much, more or less, than it was before all of these things started to take place? And I think a lot of people are looking only at the stock price, because indeed the stock price has recovered, but it is lower, right? So if we look at 2018, the market cap was $183 billion, and it is lower than that now. At $152 billion, so down about 30. That 30 being approximately the net debt that the company has taken on in the meantime as a result of all of these losses. So the net debt is now about $30 billion. The other thing I would quickly add is that, and I've talked about this before as well, that as a company's net debt increases, the volatility of its equity should similarly increase. So we have earnings are anticipated to come up at the end of July. I expect both of the cockpit voice recorder and the flight data recorder have both been recovered. I'm sure those are being examined as we speak. And some information is going to sort of filter out over the course of time. Usually, safety investigators are very deliberate in their process and try to examine every bit of evidence rather than speculate, as I'm kind of doing right now, and as many of these other YouTube experts, and I will call them experts. I mean, these are commercial airline pilots with a lot of experience, and in many cases, they've spent a lot of time examining airline accidents. But, my thinking is that it probably would make some sense if you hold the stock, or if you're just inclined to make a bet on it one way or the other, that it would make some sense to potentially at least hedge, or just anticipate that there's probably going to be some period where the stock's not going to rise materially. So different ways that one could go about doing that. Unsurprisingly, we've seen a little bit of an uptick in volatility here, but we often talk about short strangles. We talk about things like strangle swaps. in this particular case, I'm really just sort of looking at this from the perspective. I had GE Aerospace up here because I think the same sort of applies for GE Aerospace. I want to say that, again, and I think this is important. One, I'm not an expert in this, although I have an abiding interest in aviation and in aviation accidents. Sort of runs in our family as it happens. One of our producers, my brother Jay, will know that there's a history of aviation in the family. Our grandfather was an aviator. He actually died in the pilot seat of a Martin B-10 before the Japanese invaded in the Dutch East Indies. He was doing a night training mission and crashed. So long before we were born, of course, so we never knew him. But always been an area of interest of mine. And I fly a lot. So if you not as much since the pandemic, but I used to fly back and forth across the country almost weekly. So if you log 1 million miles in the air, you tend to care about how those things stay up. So things that one could think about. I'll illustrate this in GE. Again, I'm not placing blame at these companies' feet. I also suspect, we are dealing with a more than decade-old aircraft that they probably were not responsible. But if I'm going to fade these stocks, I would probably use options to do it. And I think, maybe something, and I'm in both cases, by the way, both of these companies report after, or are expected to report after July regular way expiration, which turns out to be the 18th. So I believe it's the 22nd for GE Aerospace. It is the 31st for Boeing. I was basically just taking a look at strikes that were, we'll call it 7.5% to the downside, 7.5 to 10% to the downside. So in the case of GE, that's going to take you down in the neighborhood, so it's going to be about $20 or so from here. So you're going to be looking at like the 215s, 210 puts might do the trick here. You'd be right in that neighborhood. If you're going to weeklies, it's going to have $5 strikes, something like this. I don't think that I think it's unlikely that they get fully exonerated before a July expiration, simply because I think that would ultimately come from a comprehensive report from one of the safety organizations. Here, that would be the NTSB. Air India's crash is being investigated, of course, by their local regulators. In the case of Boeing, similar thing. And of course, then you're also owning options that are going to capture the subsequent earnings. Bear in mind that if you wait until July expiration, if you have a strategy like this on, and you're dealing with the upcoming earnings, don't forget there will be a vol crush that takes place afterwards. And so what you would want to do is, assuming that you don't think that the earnings are going to actually shed new light on things, what you might want to do is adjust the position before that earnings date. And that's going to leave you very limited amounts of time in General Electric, because like I said, the expected report date there is the 22nd. For Boeing, it is the end of the month. So I think that's something that is worth looking at. So again, the Blanco Lirio channel pilot's name is Juan Brown. He's a Northern California-based 777 international 777 pilot. A lot of time in the cockpit of Boeing aircraft. And Captain Steve. Captain Steve has his own interesting stories because he's a commercial airline pilot. I believe he was supposed to be piloting one of the planes involved in the September 11th event, if I understood that correctly. But he's provided a lot of updates. Max Afterburner, former fighter pilot and commercial airline pilot. These are all people that have more insights than I can provide. But I do think that it makes some sense to pay attention to potentially affected companies. So I'll leave it at that. Alex V says commercial 777 pilot at Denoken said he ran a number of simulations. He could only reproduce a situation with similar crash if there is total engine failure. Yeah, that seems right. So a lot of the other things that have been discussed For example, I heard people speculating, oh, they didn't deploy people will generically say they didn't deploy the flaps. If you're looking at the wing, and I'm sure all of you have seen a wing in a commercial airliner when you've been flying, and some of you already know what that is, but the slats are on the front of the wing. They usually push forward and down, and the flaps are at the trailing edge of the wing. They also extend out and down. It introduces more lift at low speeds. Of course, it's a less efficient wing shape, so once they get up to higher speeds, then they retract the slats and flaps. But this is not... There are a lot of checklists, and there are a lot of safety mechanisms in modern airliners. It's unlikely that they would have that an experienced crew would have avoided all of those warnings and gone down the runway that way. So it's an unlikely mistake to have been made. So if there's insufficient lift, it's airplane configuration is a potential problem. Mechanical problems are another. The deployment of the RAT, which can be automatic, suggests that there was a serious mechanical problem and that the plane was not generating thrust, which is consistent with the Mayday call. For credit and debit spreads, Michael Walter says, for credit and debit spreads, what would things suggest the minimum risk-reward ratio? I assume you mean ratios be. So this is a very good question. Actually, there was somebody else asked a really good question last week. I'm going to have to remember what that was because all of these events ended up distracting me, and now we're focusing on this. But there is something I wanted to get to. So on the call credit spread side, so I have discussed this. One of the things in equities is that most equities have put skew or negative skewness implied in options prices. What that means is that the out-of-the-money puts will have a higher implied volatility very often than the at-the-money options, calls, and puts, in turn, which will be slightly higher than the slightly out-of-the-money call options. What this means is that very often you can sell upside call spreads and get better than 30% of the distance between the strikes when you sell them, sometimes as much as 40. And I think that is a reasonable risk reward to get somewhere between 30 to 40%. If you're getting up in the neighborhood of 50%, there's a decent chance that you have selected strikes that are very close to at the money, or maybe even slightly in the money. And that can be okay, but understand that if you're let's say I sell an in the money call spread, and let's say that there is no skew, so it's a clean 50-50 shot, one way or the other, that I can make as much as I can lose, and that the amount that I can make and the amount that I can lose are equivalent, and basically it's a break even at spot, meaning that where the stock is right now. Is there a reason why you can't do a trade like that? No, not necessarily, depending upon your specific thesis. Sometimes trading in the money spreads to make directional bets can actually make a lot of sense because you can get leverage to the directional trade that you're trying to make while still mitigating or defining your absolute risk. Somebody who also used to do this quite often, actually, on Options Action in the very early days when she was still a participant on the show, was Stacey Gilbert, who at the time was at Susquehanna. She's now the chief investment officer, I believe, at another money management firm, probably outside of Philadelphia, which is where she is based. And this was really the reason that she was talking about using options to define risk and introduce some near leverage, meaning additional leverage at spot without adding incremental risk if things move dramatically. So I don't have a problem with that. But if I'm just looking for credit spreads and I'm dealing with out of the money call spreads, generally speaking, I probably would not do such a trade if I didn't collect at least 25% of the distance. But bear in mind that there's something else, which is that how much you're going to collect is also going to be related to the likelihood that you collect it. So if you're getting 25% of the distance between the strikes, even without knowing what options you're dealing with, I'm telling you that the options market is suggesting that the chance that you actually get away with it, which means collect the premium, is higher than if you basically bring it in closer to at the money and go for a larger percentage. So part of this is going to depend a little bit on the circumstances in each specific instance. I would say this, though, and that is that when there are potential catalysts involved, I really don't like it when I see people selling vertical spreads that, where you have payoffs of, you collect 1 to potentially lose 4 or something like that. I'm just not enamored of that. I will also add, though, that I have less of a problem with that to the downside on stocks you would otherwise want to own anyway. Now, why would that be? The large reason is that generally stocks rise over time. Most of us are long stocks, not short them. It just is in the general case. And so you will often, you're going to be willing to take more risk on the long side than the upside in many instances. There's something else, too, which is that because of that same skew dynamic that I was talking about, you are often going to find that because those out-of-the-money puts are trading at a much higher implied volatility than the ones you're selling, if you're selling a put credit spread, that you simply can't collect as much premium. It's one of the reasons why selling call spreads actually can be more attractive. If you think that the skew is too steep, selling call spreads actually makes sense from a statistical point of view, and selling put spreads may not. And in fact, that's one of the reasons why I have also said, when I've encouraged people to use debit put spreads to hedge, that you're trying to do a couple of things, but usually I'm looking for payoffs of 3 to 1. So what's a payoff of 3 to 1? I have a $10 spread, it costs me $2.50. I can make $7.50 in profit. I can potentially lose $2.50 in net debit. That's your 3 to 1. That's how we come up with that. So, and that's generally the case, that if I'm going to buy put debit spreads, I'm looking for a little bit of bang for the buck. I have put debit spreads on in SPX. I already closed that system. Those are June expiration, very little left in them. Somebody else here, and I'm just going to address this now. Where is it? Jasmine here. So Jasmine Joe, hey Mike, do you think the SPY still has room to run higher, or is now a smart time to start looking at puts given the geopolitical tensions and the Fed's current stance on monetary policy? So the reason I jumped to that question, well, actually that was pretty close to the next one to get to anyway, is because I actually did add some SPX puts last week. It would have been far better to have done it today because the market obviously did very well. But I also added some SPY. So I bought SPX puts and some SPY, just expecting that there could be more volatility. I did lean a little bit short delta. So about $100,000 deltas net short. So whatever the delta position of the SPX puts was, I bought some SPY against it, but I leaned net short on that whole trade by about 100,000 deltas. Too bad, because actually today that, let's see, and again, well, it's closed. I can probably estimate, but how much would that, so let's see, how much was SPY up today? How do we close? That's not really humming speedy-wise. So that's, yeah, so actually it would have been a complete push on the trade. Yeah, 97 basis points. So I was looking at my P&L right before I turned the machine off, and it would have been a clean push. So if I had simply bought SPY and bought puts delta neutral, in my case the July 5750s, it actually would have been a push today. And that's because even though we are higher, those out of the money puts are becoming slightly more out of the money. You're kind of riding up that skew curve. So I don't mind the idea of owning a little extra downside protection here, at least 30 days out, probably 25 to 30 delta. But I'm doing it as a vol trade, meaning that I'm not just outright buying puts. I'm buying puts and I'm buying stock, and hoping I'm going to get an opportunity to trade around it, which I think is probably as good a time as any for us to move on to what you're talking about, which is this geopolitical tension issue. Cboe Global Markets welcomes Stacey Gilbert as Senior Director of the Options Institute. She'll be focused on advancing educational initiatives for institutional and retail investors. A month ago. Well, I love Stacey. I mean, she's really smart, and has a ton of experience. So the OIC is going to benefit from her being there for sure. Yeah, I mean, I've known her for a number of years, since we first met in 2008. Went to Dartmouth, majored in math. She's a smart cookie. So, yeah, good on them. I know some of the people over at Cboe. I didn't realize that, but yeah. So, go to the Cboe's educational website too. You'll hear more from Stacey over there. Okay. So, PC says, Mike, I hope your sister's wedding went great. Yeah, it did. Weather cooperated. Family members visiting from all over. My particular family had a lot of other obligations, though. It's one of those unfortunate situations when you set a wedding for the tail end of the school year and the beginning of camps and other stuff like this. It can get a little bit chaotic. So, but yes, congratulations to Joe and Larissa, and hopefully their marriage will be a terrific one. I have every expectation it will be. Okay, so let's see here. 20 Delta, 45 days to expiration strangle, which includes or excludes earnings, when to add a long 50 Delta call to it, which includes earnings. So generally, which would turn it into a call spread risk reversal, PC. So I generally favor that. So one of the things I've pointed out is that there is some academic evidence that index options are consistently overpriced, or there has been a lot of research that suggests that. We refer to that as the volatility risk premium. It is less clear that that exists in single stock land. Single stocks tend to exhibit significantly more volatility around the 4 times that they report earnings, as every publicly traded company in the United States has to each year. I saw one paper that suggested it's about 40% of all the volatility that an equity could exhibit takes place in those periods. So that's a significantly higher amount of vol associated with those 4 discrete events than the general underlying case. So there is something else, too, which I would just point out, which is that there's also a pre-announcement. I don't know that I talk about this too often, but there's also a pre-announcement period. If a company is going to pre-announce, they'll typically do so. FedEx might have been an exception when they had that complete disaster a couple of years ago, but very often they will do so, we'll call it a month in advance. So that period of time is a pretty dangerous one to be short options. I'm more comfortable with call spread risk reversals, which you're still net short options, still net short one. So if I sold a put or I sold a call, you are squeezing the balloon a little bit. But I am at least squeezing it in such a way that I'm trying to capitalize on a move in a chosen direction and mitigate the impact of a move in the direction that I don't like so much. So I would say that if I'm going to do something like a call spread risk reversal, I'd favor it more around earnings than just usually straight short strangles. But there can be instances when implied volatility on a stock is expecting something that's seems disproportionate. But you'll know, anybody who's been watching these live streams will know that we've gone over a number of examples recently, and we've seen that as big as the implied moves are, they're very justified. I think I've said that probably 5 out of the last 6 earnings we've taken a look at ahead of time, that I said, I just don't see how you sell options going into this thing unless you're doing something like a strangle swap where you own some longer dated premium against it. So Steven says, can you show the names of the aviation experts so I can check the videos? I only got Captain Steve. So again, Juan Brown, Blanco Lirio, Captain Steve, and Max Afterburner. And, it's a little bit unfair. I'm not just trying to pick those guys. Hoover is another former fighter pilot who does a lot of this sort of post-crash analysis. And I feel a little bit like I'm being unfair because I'm sure there's some other really good ones that I haven't mentioned. And I watch a lot of them. So if I get on one theory, I'll then in typical reporter or researcher fashion, I'll try to go see whether another expert has a different point of view. And it's really interesting because in the early stages, there were significantly differing opinions on this. And there was some early speculation, which now looks like probably not the case, about the flap configuration on the aircraft and things like that. So, but I encourage you to look at these things because, situations like this, it does have implications for shareholders. If you are a holder of GE, now GE's broken to pieces, so now GE is GE Aerospace. So ticker GE is the one that is relevant in this particular instance, and obviously for Boeing. Oh, one other thing I should point out, and you may find this interesting, you may not, but I certainly did, and that is that Airbus is trading cheaper on an enterprise value to sales basis than Boeing is by a pretty good margin. So I'm just going to put this. I think I can do enterprise value to sales. Let's see if we can find something here. Where is that? I don't want to use price to sales because price to sales is based on the market capitalization, and we want to normalize for the capital structure. What is it? Best sales, best EV to best EBITDA. Well, that's here. Where best sales EV to best EBIT. This is probably better. In any case, depreciation and amortization. These are real things. So I'm just going to get rid of this. I'm going to get rid of price to earnings also because there were no earnings at Boeing for the longest time. So yeah, we can see here. Let's see. I really want to get the revenue number in though because Boeing's had losses for so long. So best sales, best revenues. Where is this? EV to best sales. There's the number we're looking for. Sorry for that. Okay. So Airbus right now, that number is 1.55-ish, and for Boeing it's 2.25, right? So that's the enterprise value, which is essentially market capitalization plus net debt or minus net cash if it's net cash, but it's net debt in the case of Boeing. And so, if you're just sort of looking at the duopoly and saying, okay, which of the two would I rather buy? Now, there's plenty of reasons not to get overly enthusiastic about European companies, but I just want to make that point that it is not as if Boeing is exceptionally cheap here, in my view. I know that a lot of people are, bulled up on the company, and some of my colleagues from CNBC, I'm a little less enthusiastic until we get some more clarity. Again, not putting the blame at their feet. Just want to make that clear. So, situation room. Would you ever use levered single stock ETFs to express a view over a few days? I would not. I don't do that. The reason I don't do it, though, doesn't mean that nobody should. The reason I don't do it is because I don't know exactly what the managers are doing to create the leverage with options. And if I do it with options, I know exactly what I'm doing. So it's really as much as anything that since I don't know how they're going to respond to certain circumstances, it's more about giving myself a little bit more control. If I had it here, I don't have it here. It's funny. Somebody sent out a picture of a roll of film, I think, they posted it on X last week, and they said, if you know what this is, you're old. And I actually have a film camera, which I do use. I actually carry it around and take some pictures. I actually have to get some pictures developed, as well as digital cameras. And the way what I liken it to is that there are definitely circumstances where using a modern digital camera with autofocus and auto exposure and all that stuff is really good. There are other circumstances, though, where maybe you want to be able to exercise more control over it, and you want a manual focus lens and a fully manual camera. So in my own experience, just because I've been an options trader for a long time, I tend to favor, the more manual experience where I've got my hands on the controls. But that doesn't necessarily mean that other people shouldn't use those things. I think they can be very useful trading vehicles. And there are other derivatives that trade as ETFs that have utility. So if you want to trade the dollar, maybe you want to trade UUP, the ETF, which tracks the dollar index. Or if you want to trade oil or gas and make a short-term bet, and you don't trade futures, so you don't want to trade the WTI contract or the nat gas contract, and you'd rather trade USO or UNG, for sure, that's totally fine. I would say, though, that all of these things have bleed. They all have decay. They have decay because of the optionality. They have decay because you're paying somebody else to do it. And so all of those things add a little bit of transactional friction, add a little bit of cost, and it makes holding them over long periods of time less attractive. So if you have one in mind, we can examine it. But as a short-term bet, yeah, it's fine. Actually, I want to make this point too, which is that a lot of times these derivative ETFs, or I should really call them ETPs, because in some cases you might be dealing with an exchange-traded note, not an exchange-traded fund or something like that. But in many instances, the utility of these is also because there are accounts that want to make certain directional trades or directional investments that are ineligible to do so using options for whatever reason. That could be tax-deferred accounts. Maybe you have assets at a tax-deferred account that doesn't allow you to trade options. Different houses have different restrictions, but maybe they will let you trade some of these things like a stock. And if you can, that's the other reason that these things can have utility. So I'd also make that point. Sometimes it's because of the autofocus, the autopilot kind of thing, and other times it's because that you don't have another mechanism to do it. Okay. So, yeah, I mean, the short version is if you can, tailor it to express your view by using options, I would do that. But otherwise, seriously consider, those things as an alternative. Okay, so Raleigh, 55. With in-the-money calls, can you talk about assignment risk with regard to extrinsic value? Thanks. Sure. And I believe this was the question that it was related to this that somebody was asking about last week. So let's just talk about this. Let's pick a stock that pays a big dividend. Verizon, AT&T, these are stocks that typically pay big dividends. So I'm just going to use AT&T for our example here. Current dividend yield on AT&T is about 4% annualized. Okay? So here's what you want to keep your eye on. So the next, and this is just, a way for you to think about or look at these situations in general. So the next dividend, they're going to declare it end of this month on the 27th. The anticipated ex-dividend date is July 10th. And the ex-date is really the date that's going to matter most. As a reminder, what is the ex-dividend date? The ex-dividend date is the first date by which, if someone acquires the stock, you are not entitled to the upcoming dividend. X meaning it excludes the upcoming dividend. So even though the dividend would be payable a few weeks later, if you bought the stock on the 10th, you don't get the dividend. If you bought the stock on the 9th, you do get the dividend. So what that means is if you are trading options, and those options, call options most specifically, are in the money, the critical date for you to remember is the day prior to the ex-dividend date. And that's when you're going to start seeing a lot of call options trade. So what's going on there? Well, let's take a look. So the stock's about $28 right now. And this is a stock that does trade weekly options. Okay. So these July 11th options are a really good example. These expire on July 11th. The X date is the 10th. You, if you hold in the money call options, need to think about what you're going to do by the close of business on the 9th. All right. So if you own long call options and you did not sell them on the 9th, there's a brief window of time where you actually can decide what you want to do with those call options before they expire. You can exercise your call options up until, depending on your broker, but it's probably about 5:25 Eastern time is the last time that you would be able to put in that instruction to exercise your calls. Why would you do that? Well, the dividend involved is 27 cents. The reason you would exercise those calls is if the net present value of that dividend, which you receive 3 weeks later, so you're not going to discount it by much, exceeds the extrinsic value of the strike. What is the extrinsic value of the strike? Well, you can actually establish that by taking a look at the value of the corresponding out of the money put. So let's just take a look here. The 26 strike calls, for example. Okay, so the 26 strike calls, if you owned these calls, you can see that the bid ask here on the put side is 13 at 27. Let's just assume that the fair value for these things is, mid-market on that, okay? So mid-market is going to be 20 cents. So the value of the dividend to you is actually worth more than the value of the put. Not by much, only by 7 cents. But the net present value of the dividend is 27 cents, and the optionality is going to be about 20 cents. So there's not a lot of open interest over here. So I have an open interest change of, there's 496 calls traded on, oops, no, not on that one. This one here. Let me see. Where's my open interest? So the open interest on the 20, there's only a 4 lot. If this is something else that will be a good clue. If you're looking at this and you're saying, okay, well, how much is this worth? And you don't have some mechanism to calculate its value, a good sign that an option is probably an early exercise is if on the day prior to the ex-dividend date, in the money calls are trading huge volumes. That's a good sign that the market makers are buying and selling those calls with each other with the hopes that they can exercise the calls that they have and will not be assigned on any calls that they are short. This is something I used to do a lot in Philip Morris, for example. This is back when it was still a single listed product, but tobacco companies were typically also big dividend payers. So that's really what you're trying to take a look at. You look at the net present value of the dividend and compare it. This is your quick and dirty back of the napkin mechanism, and look at the value of the corresponding same expiration, same strike put. If the net present value of the dividend is greater, a good chance that that is an early exercise. And if you ever have doubts about this, it probably makes, you can always sell your option early, and just, get out of it that way. But what's going to happen is that the value of this, all else equal, the value of the stock is going to fall by the amount of the dividend, which in this case is 1% of the stock price. And that means that if the stock is otherwise unchanged, tomorrow that call option, which right now is worth, we'll call it $2.20, is going to be worth $1.90 to $2, something like that. So, this is the thing you want to pay attention to. So I hope that does help. MM says, tough to be long Boeing when you never know which morning you're going to wake up to a new disaster. Yeah, it is a difficult one. Look, they were riding a real, not to play off the metaphors too much, but a real tailwind because, the increase in air travel just in China alone was anticipated over something like a 5-year period to, increase demand for single-aisle aircrafts. That's going to be like the 737 and the A320 from Airbus. It was like 5,000, and they had a huge backlog. And that was the other thing that people liked about Boeing, right? So they had a huge backlog of orders. So, wasn't, in many cases, it wasn't like, oh, you're dealing with retail sales. Lululemon, how many stretchy pants did they sell right before Christmas? I mean, people buy planes well in advance. So while it is a complex industry and you have these types of risks, the flip side of that is that the order backlog gives you some visibility on company's economics going out in time. But of course, we did see that there were order cancellations, and also if they don't deliver, then that's going to cause some other problems, and they had both of those, right? So, yeah. Oh, wow, and I have already chewed up the full hour, so I'm going to just wait here for a second, see if anybody else has any additional questions that you might have with respect to either of these things. And yeah, I guess so. Let's just go over a couple of things just to sort of button this up a little bit. Boeing's down a little bit, but not a lot, based on this. It is increasingly looking like the crash was the result of a mechanical failure, dual engine failure, loss of thrust. That does not necessarily mean that either GE or Boeing are responsible, but it does mean that they're probably going to face a little bit more scrutiny. And both of these stocks are off, only fairly modestly since this news came out. Both companies are going to be reporting earnings relatively soon. So we're looking at 22nd estimated for GE, end of the month of July for Boeing. So, I just wanted to put a 5-year chart up here so you can get some context on, where you are. I wouldn't use this as a buying opportunity just yet. And as I pointed out, enterprise value to best sales and to EBIT for Boeing, not terribly cheap. For those of you who are concerned about the geopolitical concerns, do I think that, buying a little bit of hedging here? We just saw right before we came on today, there are reports that Iran is looking to re-engage in talks with Israel and the United States. I think that it's important to remember that Israel has a sort of a hard and fast position on this. They don't want them to have ballistic missile capabilities, and they don't want them to have nuclear weapons. They're not unique in the Middle East in saying that, by the way. We obviously don't want them to have nuclear weapons. For the longest time, any efforts to enrich uranium in Iran were viewed as contrary to the Non-Proliferation Treaty, to which Iran was a part originally. It was in the Obama administration that they decided they were going to be allowed to enrich uranium. I don't think they should have any enrichment capabilities. That's my own take, because it simply opens the door, right, to getting them to a point where they have weapons-grade, highly enriched uranium, which is not something that we want. And to really put a point on this, not being unique to Israel and the Western world and the United States not wanting it, MBS, Crown Prince Mohammed bin Salman of Saudi Arabia, several years ago, when asked, said that they had no intention of developing nuclear weapons in Saudi Arabia. He was sort of in that same interview. He had plenty of knocks on Iran, but he did indicate that if Iran acquired a nuclear weapon, that Saudi Arabia would be inclined to follow. Hopefully you can go and find that interview. Like I said, I think that was a couple of years old. It was just one of many things I was reviewing over the course of the weekend. It was a little bit eye-opening to me. I don't think any of us want to see a nuclear arms race in the Mideast. So hopefully they will come back and start negotiating. But we have two opposing views on this. Iran has been waging proxy wars against Israel for some time. We've been dealing with Hezbollah. We've been dealing with Hamas. Israel views this as an extension of what started on October 7th, and it's just a mess. I hope we don't get drawn into this, but obviously we're an ally of Israel's. It's kind of hard for us not to be involved or engaged in some way. What strike price or delta Do you typically target when buying SPY and put options? What is your preferred duration or expiration time frame for the trade? Well, in this particular case, I happen to buy July myself. I think they were probably 25 to 27 delta puts when I bought them, and bought and hedged them last week. Like I said, that if I'd hedged them perfectly delta neutral and hadn't leaned short delta on the trade, I'd have been better off today, because basically the amount that I underhedged is exactly what I ended up losing, which wasn't a huge amount. It was like 100,000 deltas, but it's $1,000. It's $1,000 I don't have today, which I would have if I'd hedged them straight up. If you're just buying these things on a punt, I do favor hedging them, because you're sort of betting on an uptick in volatility. And one of the reasons I was choosing that delta is because I wanted to have some convexity. So in an all-out washout, I would still get a windfall gain, but could capture some of it back, hedging the gamma a little bit in the short term. So that's because I'm expecting to see some visibility over the next 6 weeks in this. So it's not a hard and fast rule which expiration or delta I choose. It's going to be case dependent. In this particular instance, Israel is striking them hard. So, 25 to 30 delta. You wrote 3 to 4 weeks. My case, it was, they're July, so they're about 4 weeks out, a little bit more. Because remember, I did this a week ago. And I will typically seek to adjust them. I have some short-dated SPX put spreads, but that's just, a tiny little thing. Okay, so I want to thank all of you for tuning in. Not the cheeriest set of topics for us to discuss today, but important ones. And I would encourage you to, do more work on your own on the underlying topics, which includes, listening to what the Israeli government has to say about their intentions, how Trump is responding, because I think it seems to be that he's trying to avoid being drawn into this, which I think Netanyahu probably would like to see us get drawn into it more thoroughly. Certainly improves their position if we were, but I don't know that that's something we want. And then obviously paying attention to this tragic incident in India. And as we learn more, we'll find out whether there are any implications for General Electric and Boeing. Hopefully this is a really unusual and isolated event. We'll see. Thank you all for watching. We'll see you next time. Wednesday, 4:15.